How the Fed's surprise rate hike will impact your wallet and finances for years to come. 1. Savings account rates start creeping up. As rates rise, banks will start offering higher interest rates on savings accounts and CDs to attract deposits. Online banks tend to hike yields fastest, so your existing savings will earn better returns. Shop around for the best deals and be ready to move funds once your bank lags behind rivals. This dynamic environment requires vigilance, ensuring your hard-earned money continues to work for you and takes advantage of evolving market conditions for optimal financial growth. 2. Mortgage rates surge, hurting home affordability. Mortgage rates track the Fed closely, so additional rate hikes will make financing a home much less affordable. Rates for a 30-year fixed mortgage have already surged above 6.5%. Home prices may fall as demand declines. Lock in lower rates now before further increases hit. Consider consulting with mortgage experts to explore options like refinancing to secure a more favorable rate, ensuring your home buying aspirations align with the evolving interest rate landscape and your long-term financial stability. 3. Credit card rates will rise over time. Most credit cards have variable rate APRs tied to the prime rate, which moves in sync with the Fed. Expect your credit card interest rates to rise over 1 to 2 billing cycles. Carrying balances will get more expensive as you pay more in interest charges. Consider transferring balances to lower rate cards before rates adjust upwards. Furthermore, take proactive steps to manage your credit card usage effectively. Create a realistic budget, prioritize paying off high-interest balances, and explore alternative payment methods to minimize reliance on credit cards. By making informed financial choices, you can navigate interest rate changes with greater ease and financial stability. 4. Home equity loans and HELOCs will reprice. Higher home equity loans and HELOC rates will also rise as lenders pass on higher borrowing costs. Using home equity will get more expensive over time. Lock in fixed interest rates now on any existing lines before automatic rate adjustments hit. Have a strategy to pay down balances when teaser periods end. 5. Auto loan rates are already climbing. Auto loan rates offered by dealerships are rising in tandem with the Fed hikes. If you need a vehicle soon, expect finance charges of around 5-7% for a new car loan and 8% or higher for used. Shop around vigorously for the best rate and secure pre-approval. Consider paying in cash if possible to avoid financing entirely. 6. Student loan rates will increase for 2023-2024. Federal student loan interest rates are set annually based on 10-year Treasury rates. Expect new loans issued for the 2023-2024 academic year to carry higher fixed rates in the range of 5 to 7% or more. Consider community college for GE requirements before transferring to a university to reduce borrowing. 7. Newly issued bonds will pay higher. Yields bond investors benefit from higher rates since newly issued bonds pay more interest. This allows bonds to play their traditional role of providing stable income and diversification during stock downturns. Target shorter-term bond funds and treasuries as they perform best when rates rise. 8. Existing bond values decline as rates rise. While new bonds pay more, rate hikes depress the values of existing bonds issued at lower yields. Manage interest rate risk by holding bonds with mid-range durations, laddering maturity dates, and diversifying broadly across asset classes. Don't sell quality bonds solely based on short-term price drops. 9. Rate-sensitive stocks, like utilities, decline. When rates rise, stocks like utilities, REITs, and telecoms see valuations fall as their dividend yields look relatively less attractive. For your stock portfolio, emphasize sectors like financials, industrials, healthcare, and energy that benefit from rising rates. Stay diversified and keep investing based on long-term goals. 10. Borrowers face challenges with budgeting and cash flow. As the Fed raises rates to fight inflation, consumers and business borrowers will find managing budgets and cash flow more difficult as loans become more expensive. Avoid taking on large new debts when rates are high. Build up emergency savings funds to handle income disruptions that could result from slowing growth. 11. Retirees must review portfolios and income strategies. For retirees, higher rates provide larger payouts on bond interest, CDs, and savings. But bond portfolio values may decline in the short term. Review asset allocation and consider holding some cash to deploy at higher yields down the road. Seek advice to determine if interest gains offset capital losses from rate-exposed segments of your portfolio. 12. Additional big rate hikes are coming in 2022 and 2023. The Fed has signaled this 0.25% hike marks just the beginning of an aggressive tightening cycle aimed at taming high inflation. Expect sizable quarter-point or half-point increases at every remaining Fed meeting in 2022 and likely into 2023. The destination remains uncertain. Stay nimble as the environment shifts. 13. Regularly review your financial plan and goals. Pay close attention to inflation reports and the Fed's subsequent rate moves. Be ready to adjust your financial plan and goals as needed. Model different rate scenarios and their impact on cash flow. Seek fixed rates where possible to lock in stability. Review exposure to market segments that will be most affected. 14. Shop around and negotiate the best rates. In a rising rate environment, having the discipline to regularly shop around for the best deals on loans, savings yields, mortgages, and insurance makes a difference. Negotiate with providers to lock in rates and terms that optimize your situation. Seek promotional offers and be ready to move funds when better rates appear. 15. Focus on long-term financial health and security. While the Fed's rate hikes will influence short-term decisions, stay focused on the long-term health and security of your family finances. Avoid reactionary moves like panic-selling investments or taking on high-risk loans. With balanced adjustments and prudent decision-making, your financial life can thrive well into the future. The Fed's surprise 0.25% rate hike signals just the start of monetary tightening that will broadly impact personal and business finances for years to come. By modeling scenarios, responding nimbly as conditions change, focusing on the long term, and making prudent adjustments, you can adapt and even capitalize during this new rising rate environment. Stay proactive, and your financial future will remain bright no matter where rates end up.